Another analysis technique that companies frequently do to analyze their financial position is a vertical analysis. And a vertical analysis is analyzing the relationship between the balance of any one given line item that you have, any one given account, and a base amount, which is a bigger picture on your financials. So on a balance sheet, you could be asking what percent of our total assets are in the form of cash or receivables. You could also ask yourself, okay, we needed to finance activities during the period, and how did we do that? What percent of our financing came from mortgages payable? In terms of an income statement, you can do a vertical analysis to figure out where the money you brought in went to. What percent of your revenues ended up going towards covering a different expense? And the formula that you do to do this is the specific items balance, whatever account you're looking for, divided by what they call the base amount, which is that bigger overarching number that you have. On a balance sheet, that base amount will be the balance number, either your total assets or your total liabilities and equity. On an income statement, the base amount will always be the amount of sales revenue that you generated during the period. So for Smart Touch over here, we have a comparative income statement, their income from the last two periods that we're doing a vertical analysis of. And what we're going to do is we're going to take the balance of every single individual line item that we have and divide it by our base amount, which for this is going to be our sales revenue. So we're figuring out what percent of every sales dollar that we made went towards covering the cost of a specific item or turned into a certain measure of profitability. Let's start with COGS. It was 513,000. If I take 513,000, divide it by the 500 or 858,000 and convert it to a percentage, I see that 59.8% of the sales revenue that we generated from selling goods went towards the cost of either acquiring, buying, or producing those goods that we eventually turned around and sold. Same thing down here, we got selling expenses, so like marketers, salaries, advertising, etc. That was 126,000. We'll take that 126,000 divided by the 858,000 and you get 14.7%. So 14.7% of every sales dollar, or if you want to look at it another way, almost 15 cents out of every sales dollar went towards covering our costs of selling. For your measures of profitability, you have your gross profit, what your markup was for the period above what you sold it for, above what it cost you to acquire or produce. So for us, we had $345,000 in gross profit. Divide that by the 858 that we had in total and convert it to a percentage. 40.2%, or about 40 cents out of every sales dollar, ended up being profitable margin, gross profit. We had other stuff to pay for. Our operating income, after we accounted for our other aspects of operations, ended up being $101,000. Well, 101,000 out of that 858,000 represents 11.8% of our revenues. After we accounted for all of the costs of operations, we only ended up with about 12 cents on every single dollar being left over after we had to cover everything else. And then we've got our others, and for us, the big one we have here is our interest expense. We have loans that we have to finance. We also have taxes that we have to pay. After we've accounted for all of those, our bottom line income for the period was only $64,000 out of the $858,000 in revenue that we generated, which means that we only ended up having net income equal to 7.5% of our net sales revenue, or 7.5 cents on every dollar that we made ended up being income. How does that compare to the prior period? You would do the same thing. Take the balance of every individual line item and divide it by the base amount for that period, which is the net sales revenue that we had in 2025. So 509,000 divided by 803,000 converted to a percentage means that last year, 63.4% of our sales revenue went towards covering the cost of acquiring the goods that we turned around and sold. And you just repeat the same process. It's every single number on here always divided by that amount of sales revenue that you had for the period, and then you express it as a percentage. Doing this for 2 years allows you to look at a bigger trend in your company. What happened to our overall profitability? It went up in terms of both dollars and, in this case, percentage. Well, why is that? Did we get more profitable because we managed to find a way to cut our operating expenses? Well, it did go down, but it only went down by like a percent right here. That doesn't account for the whole increase we had here. Did we pay less taxes? Well, no, we paid more taxes, but that's inclined to happen when you have a higher level of income. What's the real reason for Smart Touch's increased their profitability? And that number seems to be up here. We found a way somehow to make cost of goods sold a much smaller expense in terms of a percentage of our total revenues than it was last year. We managed to increase revenues at a greater rate than we increased cost of goods sold, which led to Smart Touch Learning's overall profitability almost doubling. For the balance sheet, it's the same concept, and your base amount that you're always going to divide by here is the balance number. So it'd be $787,000 for 2026 and $644,000 for 2025. And then you're going to take each individual line item and divide it by that balance number and express it as a percentage. So for the assets portion of your balance sheet, for each one of those, it would tell you what portion of your total assets are made up of that specific account. Only $29,000 of our $787,000 in assets is in the form of cash. That's 3.7% of our total assets. 29,000 divided by 787,000 and expressed as a percentage. And you would do that down the whole entire line, and you would get to see stuff about your trend of your business. What about our overall assets over here? Well, only like a third of those are current assets, things that we expect to convert to cash within the next year, while the other 2/3 of it is in the form of long-term assets that we have, non-current assets, and the big chunk of that is our PP&E. Way more than half of what we have to work with to help us generate revenue in the future is in the form of property, plant, or equipment. On the bottom, we're going to look at this from the perspective of how did we finance the activities that we did during the period. And there are two options for that: is you finance them via debt or you finance them via equity. So for debt, how do you finance things? Well, you can take out a loan. Even a very short-term loan from your vendor would be your accounts payable. You can take out short-term loans from the bank. That would be our short-term notes payable that we have right here. And we can figure out what percent of the financing that we needed, the $787,000, came from each one of these individual line items. And 9.3% came from accounts payable, 5.3% came from notes payable, etc. If we don't want to finance with debt, we can finance with equity. How did we get the money that we're using to conduct operations? Well, we see here that almost a quarter, 23.6% of it, came from our common stock, and 21.6% of it came in the form of retained earnings. So we have a breakdown of how we're making things happen for our company right here, and we're finding every one of these line items, these percentages, by taking the amount of the line item and dividing it by our base amount. And we can compare to last year as well right here. We're always just going to take the balance of each line item during 2025 and divide it by our balance number for that year, which is $644,000, and express it as a percentage. So for cash over here, $32,000 divided by $644,000, expressed as a percentage, is 5%. Last year, cash was 5% of the total assets we had to work with. Very small number, and the purpose that we do it for 2 years is we can compare. We see that that even went down. Cash is a very, very small portion of the assets we have to work with. Maybe that's something we want to keep an eye on. What about the funds owed to us for sales that we made on account? Well, last year it was 13.2% of our total assets. Now it's up to 14.5%, which means that the things that we have to work with to help us conduct business during this upcoming period, a bunch of that's going to be dependent upon us collecting our receivables and ultimately converting them into cash. And the same process goes on here. Just take the balance of each individual line that you have and divide it by your base number. So one more. Last year, 36.6% of our assets were current assets. It's down to 33.3%, which means the things that we have to work with, a larger portion of them, it's going to take us longer to use those things in operations to eventually convert them to cash. And then the same thing down here. For your liability and equity side, you would take the balance of each line item, divide it by your base number. In this case, it would be 644 for this year to get the percentage. So I will take one that looks interesting to talk about, and that can be our long-term liabilities. $198,000 of what we did in 2025 was financed via long-term liabilities. Divide that by the $644,000 balance number, that's 30.7% of our makeup. And that number is much lower than it was this year, which means we had a big increase to the portion of our business operations that are being financed by a mortgage, bonds, long-term notes, one of those things. That's a huge increase that we had right here. So we can expect in the future that we're going to have a much higher interest requirement that we have to pay on our loans. Very nice thing about this formatting, expressing things in percentages, is it allows you to compare yourself to another entity without what they call the dollar value bias. Big numbers always look more impressive. It's just the way that it is. But depending on the size of the two different businesses, a big number for one business is not the same as a big number for another business. If you are, a small tech firm that's a startup somewhere, you could have, $1 million in cash out of your assets, look like a lot of cash to have. If you're Apple and you only have $1 million in cash on the books, you're gonna have a hard time financing stuff that needs to be paid for immediately. So instead of looking at the comparison between your company and another company in terms of the dollar value that you have expressed, it's better to look at it in terms of the percentage, how your makeup is. So let's go and compare ourselves, Smart Touch Learning, to one of our competitors here, Learning School. This is the income statement. Instead of having the dollar amounts, as you can see right here, these are all the same numbers that we had on our income statement earlier. We're going to compare to Learning School. Now, they might be a lot bigger than us. They might be a lot smaller than us. We don't know, and we don't care because we're just looking at the model of what we have. And this allows you to isolate differences that your big company has versus the companies that you're competing against. And right here, I see two numbers that stick out to me. Firstly, Learning School is doing a way better job of turning their sales into bottom line profit. They're 28.6% to our 7.5%. We, pardon my French, suck at that. Why is that? Why are they able to maintain such a higher level of profitability than we have? Is it because of their operations, their selling and administration? It's pretty close. I mean, they're actually paying a little bit more in terms of percent of every sales dollar than we are. Nope. Big difference is right here. Somehow, Learning School's cost of goods sold is so much lower than ours. So if we need to make improvements, we need to make managerial decisions about how we're going to improve the profitability of our company, that's the spot to look at. Can we get these products cheaper somehow? Or another way to look at it, are we charging enough in relation, enough markup, enough margin above the cost that we are paying to acquire or produce these goods? And this concept is called benchmarking. Benchmark against something else at all times to make sure that you're keeping up with the Joneses, that your business looks like the other businesses that you want to be comparable to. They could be a great one, your key competitor, Coke versus Pepsi, but they could also be against the whole entire average that you have. So not just Coke versus Pepsi, but Coke versus every company that makes soft drinks. Schweppes, Dr. Pepper, all of those. You can benchmark your figures against the numbers. Where do you obtain these from? Well, for a key competitor, you can just go and find their financial statements. If they're publicly traded, they have to put them out there into the world. You can go and grab their financial statements, do an analysis, and compare. And you can even visualize. And this is the same exact thing that I was talking about earlier. Instead of looking at it in terms of an income statement, if you're trying to make a pitch to somebody that you need to reduce cost of goods sold, in this case, this pie graph does a lot of good work right here. Like, we want our orange slice to be as big as humanly possible. And right here, they'll see that their orange slice, their net income, is way bigger than ours. Why? Well, what's taking up a bigger slice of our pie than the slice of their pie? The blue square, which is our cost of goods sold. So this is an example of benchmarking. We're comparing ourselves to our primary competitor, which happened to be Learning School. But if we're in a sector, if we're in some type of operations where we have a lot of competitors, instead of looking at one person, you might want to look at a bunch of people. And that would be the industry average. And how do you figure that out? How do you know what the average gross profit percentage is for everybody that's in educational technology or everybody that makes purses or whatever? Well, there's different places that you can go and you can find an industry average. The U.S. Census has a QFR program, the Quarterly Financial Report Program, where they go through and they analyze a bunch of financial reports to give people this information to work with. The SEC will also have something that's incredibly similar, where it's the data about a bunch of different entities that you want. But in today's day and age, the best way to get useful information about the industry that you compete with is go into the private industry itself. There are so many companies that do analytics. So instead of going through the process of doing all of these things in-house individually, they'll go through and they'll grab everybody's financials and they'll set up the information not only where the way that gives you the number, but a way that you can break it down even farther. So if you need an industry average with a good enough set of information that came from some company that specializes in this, you can figure out not just what the percent is for somebody that makes shoes, but what the percent is for someone that makes shoes in North America, or what percent it is the industry average for people that make shoes that operate in the Northeast, what percent it is for people that make shoes that operate in the Northeast that is made by companies that have less than $5 million in total assets. Like, you can drill down so far with information. So nowadays, while these two definitely exist, most large companies have turned towards outsourcing this information obtainment to a private industry, and your task as the manager of the company is going to be to work effectively with the information that you're provided.